All right, it's time to begin. So welcome everyone here. Chris Capre, founder Second Skies. We have the weather report here brought to you by FX Street. Good to see everybody here today. Strong numbers so far, and my guess is more to come because the gates are open and this class has begun. So, fantastic. So just to let you all know, I'm broadcasting via San Diego. I'm on a semi-vacation, semi-business trip here, and I am actually on a new laptop here. As soon as I landed here on vacation last week, my laptop, I plugged it in. I plugged it into a wall that had a short problem. And that short problem decided to make its way all the way into my laptop and say, goodbye, laptop. Your time has come. Ended the lifespan of the laptop. And the beautiful thing about that is I got to buy a new laptop, which is a cool thing. So I had a perfect excuse, the best excuse I could possibly think of to buy a new laptop. And here I'm working on it. So I'm really excited. This thing is kind of fun, and hopefully everything's going to work okay here. I think we're off to a good start. So, all right. So before we begin, I want to say hello to everyone here. This class is for you. So at any point that you have questions, chime in your questions at any point in time. I can handle questions in real time. I can even handle multiple questions in real time. I'm a multitasker. And so that being the case, I want your questions to get answered, and especially if they're appropriate to the material at that point in time. And even if they're not, fire your questions away. I'll put them in my mental queue, and I'll be able to just roll them out one at a time there as I dice through them. So I want your questions to get answered. Fire away with questions. Don't hold back. Ask away. Now also, if there's anybody new here to this class for the first time, I would like to know, that would be great. Raise your hand and let me know if this is your first class. And if it is, that would be great because that'll give me a context as to how I could start off this lesson here today. So is there anybody here that this is their first time to the weather report here and Ichimoku Cloud trading? And if so, that's fantastic. That's a good thing we all get to review. So anyone here for the first time, please let me know. Now, fantastic. Rob, you are new? All right, great. Well, it's good to have you here, Rob. And Ned as well, and Hanindo. Fantastic. We have a nice new crowd here. Good to have you here. Welcome. And Millward as well. Good. All right, fantastic. So, first of all, let me delete this here for a second and show you how the traditional Ichimoku Cloud will be as is. Okay, so that is the traditional Ichimoku Cloud you'll see there. And it's ironic, last week we were talking about how IntelliCharts doesn't project the cloud into the future. This weekend I got a software update from them, and bam, they must have heard me. They must have knew I was coming for them. Here's the new cloud projected into the future, which is actually going to help us a lot in our analysis and our work of Ichimoku Cloud, because this is actually the key component of here, and I want to show you kind of some fascinating things about it. This allows us to talk about the Ichimoku Cloud in its full gamut, basically. We're going to be able to unleash the full gestalt of what the Ichimoku Cloud is here. All right, so for those of you new and for those of you who've been here before, the Ichimoku Cloud is a method. It's a trading. It's not just an indicator. It is a full-on method to basically place trades. It has all the information you need to place trades, when to get in, when to get out, stops, limits, entry, exits, and the whole thing. Now, there is a traditional Ichimoku Cloud, and I'm going to show you the traditional Ichimoku Cloud. But then I'm going to talk about my modification of how I trade it and the reasons why I do that. And it's very important. I'm actually in the process of finishing an article for Currency Trader. It's looking to come out on the next issue, and it's all about the Ichimoku Cloud and my revised method for trading it on the 1-hour chart. We're going to talk about on all time frames, or as many time frames as possible. But I want you to understand the method before you start applying it to your trading here. Now, what you're seeing here, this little blue shading line here, this is the cloud. Okay, so with this thing right here, this is the cloud, and what that represents is the cloud is it's called the Kumo. So if you hear me calling it Kumo, that's what I'm referring to. It represents support and resistance. And this is the beautiful thing about it. It's actually composed of two key sets of variables, and they're both different. Now, the brilliance behind the Ichimoku Cloud, there's several things about it that are absolutely brilliant. First of all, it's sent into the future, as you can see here. And so this is designed to give you future levels of support and resistance here. The thickness of the cloud is actually going to determine the likelihood of there being a reversal or a rejection as some sort of bounce occurs. Thicker the cloud, obviously, the thicker the support and resistance, the less likelihood of a reversal. Thinner the cloud, the likelihood that a swing change can happen and a reversal or a swing change can happen in that process, because there's not much there to really put up a fight. And so this is going to be great information not only to us right now, but also into the future as to how it's going to offer support and resistance. Now, just to let you know real briefly, because I'm on a laptop and I'm here remotely, I don't have, my 4 trading screens that I have at home, and so I have to kind of check back with the hotcom room. And so if I don't get to your question within a fraction of a second like I normally do, please apologize. I apologize. I'll need a minute just to switch back and forth. So I appreciate your patience ahead of time. Now, getting back to this cloud here, here's the beauty of this. It's got 2 components. I'm going to talk about it here, but first I need to talk about these lines. This white line here is what we call a Tenkan line. This is a 9-period exponential moving average, and you can tell it's the longer or the shorter moving average because it's real tight against the price action. Then we have this red line, which is the Kijun line, and this is a 26-period moving average. It's much further away. Now, the reason why they chose 9 and 26 is actual historical gap, basically. So when Goichi Usada, who is creating this, he originally started work on this pre-World War II, and then he finished it post-World War II in 1968. So that being the case, what had happened was back in that time period, the Japanese were actually working 6 days a week. They had a 6-day work week. And so if you count that up in the normal traditional weeks, 26 days wouldn't count for an entire month, therefore the Kijun line. And then the 9 would be a week and a half worth of price action. Why he chose a week and a half, I don't have the historical context behind that. But it was designed to measure a week and a half worth of price action. This was designed to measure an entire month worth of price action. Since then, the Japanese have shifted to a 5-day work week. But the thing about it is that most of the Japanese traders have not switched the parameters on the Ichimoku Cloud. They've left it at the 9 and 26 for the EMAs there. So that being said, since the bulk of the people who are using the Ichimoku Cloud are using this on the traditional time frames, I keep it on the traditional time frames. I've seen some modifications to accommodate now the 5-day work week, and so that has, but it's very uncommon. And so since it's least commonly used, and technical analysis is really a game of the most commonly used, or the greatest common denominator, then that being the case, that's the parameters I want to stick with. Now this purple line you see here is called the Chiku Spin. I actually don't use it, but I do want to talk about it now. And so the Chiku Spin basically is taking the current, it's basically taking the, how could I describe it? The most current closing price over the last 26, current closing price, plotted 26 time periods back. Now, why is this significant? It's significant because it's trying to give us a reference how current closing price is in relationship to time in the past. And so it's really trying to give us indications about support and resistance and where future support and resistance besides the cloud will be. So if the current closing price, like for example when it was down here, the current closing price would have been here 26 time periods past. Well, if there was no past price action around that level, really threatening that level below this level, then it would say the line of least resistance is to the downside. The thing about the Chiku Spin is we can detect that visually. So to me, I don't use the Chiku Spin. I don't need the Chiku Spin there, so I delete it since I already have enough indicators out there. Now, I got a question here. Scott says, Chris Caprimo, man, thank you, gracias. Good to have a fan. So you're using this on the Euro-US dollar as well, not just the JPY pairs. That is correct. I use this on most of the majors. I use it on Euro dollar, pound dollar. I use it on dollar Swiss not as frequently. It's much cleaner on the Euro dollar than it is the dollar Swiss. I use it on the Aussie dollar, the Kiwi dollar. In terms of the dollar CAD, because of the general choppy nature of the CAD, and also because the way the order flow is on the dollar CAD. Dollar CAD has a good portion of the order flow coming through when all the oil contracts are coming through during the U.S. session. So the dollar CAD gets a huge surge in volatility during the U.S. session, but it remains very dormant for a good portion of the other time period. And so because I don't use it on the dollar CAD too much, but the rest of the majors I do, and then I use it on all the yen pairs except for Swiss yen and CAD yen. And so other than that, I fire away with it there. So hopefully that answers your question. Now, Goss has a question here. Is it true the thickness signifies volatility for the Ichimoku Cloud? The thickness of the cloud, or the volatility you can expect, and what is the correlation? You know what? There's kind of an interesting debate about that. The thickness, to me, does have some measure of volatility, and let's talk about the construction of the cloud. The construction of the cloud is actually composed of two parts: Senku Span A, which is this white line, and Senku Span B, which is this blue trim here. And then the shading is the space in between. Senku Span A is the taking of the values of the Tenkin line and the Kijun line, dividing it by 2, and calculating it 26 time periods ahead. Now, Senku Span B is the other brilliant part about the Kumo. The Senku Span B is taking the last 52 time periods. So right now we're on a daily chart. It's taking the last 52 days, and it's taking the highest high plus the lowest low, dividing it by 2, and sending it 52 periods ahead. So that being the case, if you're taking the highest high and the lowest low and dividing it by 2, what does that give you by default? Any guesses there? Highest high plus the lowest low, dividing it by 2 for the last 52 days. Any guesses? I'd be impressed if somebody gets this. Pivot leg. Ooh, that's pretty close. Average, close. 26, not quite. Because remember, we're measuring price action. It does give you 20%. Yes, Simon's got it. The 50% Fibonacci. It gives you the 50% Fibonacci of the last 52 time periods. So let's say it's roughly right around here and roughly right around here. Halfway in between is roughly right around here. Now, I don't know if that's 52 time periods divided by 2. Let's kind of figure this out. 3, 6, 5, 15, 18, 21, 24. Actually, why don't we just, 24, 27, 30. It's like right around here. I think this would be your highest high. If it's not that, then it would be this one. But that is your 50% retracement, and I think it's more like this one here. So there is your 50% fib right there. So the cloud has Fibonacci built into it. This is beautiful. This is completely elegant. It's showing us, this is just the brilliance of it. And what was Goichi Hasada's reasoning for that? Well, his reasoning was this. Look, for the last 52 time periods, we want to take the actual price action, and what we want to do is divide it in half. By dividing it in half, we are really kind of creating this upper half and this lower half. This lower half region would denominate a price area or region that is saying, hey, when it's in this lower half of the region for this downtrend, then that being the case, it's still probably in a continuation mode. But as it breaks through the upper half, well, then the chances of that trend continuing are very unlikely. We're getting a request here to draw a fib. Let's do it. Let's see if it works. I got to delete this line for a second here. And look at that. So if I'm drawing it close, maybe it's this one here. But one of these, and there you go. It is that high there. So there's your 50% fib. For all ye doubters, there you go. There's the brilliance, another layer of brilliance for the cloud. Absolutely fantastic. Totally amazing. It just shows the ingeniousness and forethought of Goichi Hasada and his thinking there. He was a journalist too. He wasn't even a trader. He was a journalist. And so now, what does the Ichimoku Cloud become? It's because of the construction of the cloud. Well, it becomes a leading indicator, very much like Fibonacci's are. They're telling us ahead of time where future support and resistance levels will be, and so, or likely will be. And the cloud shoots 26 time periods in the head. It's giving us a leading indicator of the likelihood of a reversal or no swing change at all, or a rejection. And so to answer your question, Goss, in some sense it is a measure of volatility. Because if the highest high and the lowest low have a deep, base to them, well, then that can only be created via volatility. And also for the adjustment of the Chiku Spin A. For that to have its current value, the 9 and the 26 periods have to have some sort of volatility or lack of volatility, and the ascension or descension or the climbing or declining of the Chiku Spin A is a factor of that. And so the answer to your question is yes. Now, do we really need to use the cloud to gauge volatility? We don't need the cloud to gauge volatility because the cloud does other things for us. The volatility really isn't going to give us too much information in terms of saying, hey, is this going to really provide us with a trade opportunity? Because it gives all the other things you need to have your trade opportunity. Now, how does the signal work in the Ichimoku Cloud? This is very important. And I want to switch into a 1 hour time frame here. So I should have answered all the questions at this point here. Okay. Now, the signals that you get on the Ichimoku Cloud are based upon a crossover, first of all. First and foremost, it's based on a crossover. It's the very beginning of creating a signal. Now, what is the crossover that we're looking for? We're looking for a crossover of the Tenkan line over the Kijun line. An upward crossover, very much like a MACD, would be a traditional beginning for a bullish signal. A downward crossover, as we see here, would be the traditional signal for a bearish signal. Now, just because we get a crossover, traditional Ichimoku Cloud would say, hey, you need a crossover first, and then you need the price to break the cloud second. Now, there's two camps in the Ichimoku Cloud, culture. One culture says we have to follow the traditional method, which is that when the crossover occurs, price needs to have already broken through the cloud. If the price hasn't broken through the cloud, there is no trade. That's the very traditional camp. There's a second camp, which is in some sense a smaller group of people, but I think is the more intelligent one. This is the camp that I belong to. In fact, I might have been the person who created this camp, because if you look at all the Ichimoku articles out there, they don't address this issue. So my guess is they don't address it because either they're not aware of it, or they just go with the traditional Ichimoku analysis. If you look at all the articles on the website there, on the websites, one of them I wrote. It's the one at fxwords.com. But there are several others there. And all of them talk about how the price has to have broken the cloud at the time of the crossover, or they don't talk about the price breaking of the cloud. So that means they're generally more aligned with the traditional camp. And so I might be the sole trailblazer in this one here. And that's why I'm going to be publishing a book on Ichimoku Cloud trading in 2009, because I think there's another way to really relate to the Ichimoku Cloud. Now, the second camp is this. When the crossover occurs, price action doesn't have to break the cloud at that time. It could break it in the future, and as long as it does, then that gives us the impetus for the signal. Now, traditional Ichimoku traders will take all types of signals. We have three types of signals within the Ichimoku Cloud. We have a strong, medium, and weak signal. The strong signal, for a sell signal, is when you get a crossover below the cloud. So a crossover downward below the cloud. It's strong because we've cleared through support in this case, or we've cleared through the cloud when it happened. And so that being the case, that's a strong signal. A crossover occurring inside the cloud, as this one does right here, that is a medium signal. And so this one was barely a medium signal, but it was. And so that's a medium signal right there. And in this case, it's an upward crossover. It's medium because we're crossing over inside of the cloud, which is support and resistance, which means we had to have chewed through some orders just to get through there. And if the crossover is occurring inside the cloud, likely price action is either broken through the cloud or it's in the process of chewing through it. So that's a medium signal. And a weak signal, in this case, for a sell signal would be above the cloud. This would be a weak signal because we're getting the crossover above the cloud. We haven't even gotten to support yet. We still need to chew through support. That's a weak signal. Traditional Japanese Ichimoku traders, if they get a crossover and the price is already broken through the cloud and it's a weak one, they'll take the actual trade. I do not. I am part of the, I guess you could say, I don't know if we want to call it the Neo Ichimoku traders. I'll have to think about what I'm going to call that camp because I think I'm going to be the first person to label this here. But that being the case, I don't take the weak signals at all. Why? Well, first of all, if anything on the planet is saying, you know what, we're going to give you a weak signal, I am really not too inspired to take that signal by default. I don't care how accurate the system is. You're saying you're going to give me a weak signal and I have a choice between weak, medium, and strong. I'm not interested in the weak signal. So just by sheer intelligence, I have no interest in any weak signals whatsoever. Second of all, if I were to get a weak signal, when you look at most weak signals as a whole, by the time they break through the cloud, they often don't produce too much more of a move. And so therefore, you're not catching the move when it's really being generated. I like to catch moves at the closest point to their origin of being generated, or saying, hey, I've now created a signal. I like to be as close to that as time-wise as possible. That gives me the greatest advantage because I'm just trying to catch the momentum or the wave of this particular move. And so because of that, I don't trade the traditional weak signals. I just completely abandon them. And I've found that even though it decreases the frequency of my trading, it increases the accuracy tremendously. And so that being the case, I abandon them. The only signals I take are medium and strong signals. Now, again, you need a couple qualifications. First of all, you need a crossover, according to my method. And you need a medium to strong crossover, so that's the second qualification. The third thing is you need price to break the cloud. I do not need price to break the cloud or have broken the cloud at the time of the crossover. I am totally content with waiting for a crossover, finding a good medium to strong one, and then watching price break the cloud after that crossover there. And so that being the case, those are the three qualifications for the signal. Now, in terms of breaking the cloud, you should be asking, how much do I need the price action to break the cloud? Well, first of all, if it's on an intraday time frame, the two intraday time frames I like to use this on the most are the 30-minute and the 1 hour. If it's on the 30-minute or 1 hour, I need price action to break it by 6 to 12 pips. Now, what is the 6 to 12 pips measurement? What that is basically, I don't need it to close 6 to 12 pips above the cloud or below the cloud, but I need it to break 6 to 12 pips, and whether it's 6 to 12 depends upon its volatility, and it also depends upon the volatility of the environment. My general method in this is I'm looking for price action to lean. It's more towards the 12 pips than the 6. There are going to be some pairs that are slower moving. For example, an Aussie and Kiwi dollar as a whole generally don't move as much as the pound dollar, pound yen. And so because of that, less pips is fine with me. But on the more volatile pairs, I like 12 pips. Also, we're in a general high volatility environment right now. And since we are in a high volatility environment, I generally like there to be more pips clearing the cloud than less pips. Now we got our question here, Polly G. How about the trend direction, like in the case of the medium signal pointing upwards 2 days ago? Right now, the overall USD is bearish, and the signal is opposite trend direction. And so my guess is your question is, do we take this in opposition to the major trend direction? Well, first of all, let's look at the time frame of the trend. The time frame of the trend we're talking about is on a daily chart. Okay? So on a daily chart, this is the general trend. Now, some people may argue this trend is temporarily over, or at least to some degree, because we've had a pretty steep bounce here. You know, 139, actually it was like 138 3/4, all the way up to 147. It's an 800 pip bounce. So some people may argue a good portion of the trend is over. And right now, we're in at least a strong retracement mode. This isn't some weak corrective move. These candles are large, which means there's an impulsive bounce. So let's say we do agree on the fact that the Euro-US dollar is still in a downtrend. Let's say I agree that with you. I'm agreeing to that on this daily time frame. However, on the intraday time frame, you could have shorter term trends. You could have trends that can go for anywhere from a few hours all the way up to a day and a half. And if that's very reasonable, if that's totally reasonable that you're going to get those signals, then to me, I personally take those signals regardless of the larger trend direction. And I've even found that the medium and strong crossovers, even though we have this daily, downtrend that we both agree we're in probably, the bottom line is that these medium and strong signals will make you money. And so by default, they're kind of filtering out saying, hey, doesn't matter what trend direction in, right now, this momentum move that I'm creating is highly likely going to go in this direction. And since that is the case, since it has a high probability by the nature of it being a medium and strong signal, well, then that being the case, I recommend taking this trade. That's what Master Ichimoku would be saying. And so since Master Ichimoku says that, I would be saying that. And so I have no problem taking these buy signals here on these long positions, even though the major trend is down. Because this type of the system, or this method that I use, is designed to filter out the trades that are unlikely to produce those signals. And so that being the case, that is how I take those signals. Hopefully that answers your question. I am working with some statisticians who are doing some analysis with me on the 1 hour chart. We're going to do the 1 hour, then we're going to do a 30-minute, and then we're going to do the daily chart to test the accuracy of the system over a longer time frame. Once we have our results, we're going to publish them in Currency Trader, at least for the 1 hour chart. And then as I get more and more information, I'll be looking to publish them because I want to know, hey, let's say we are in some sort of general downtrend and we've had nothing less than a 50% retracement. What are the probabilities that the intraday 1 hour long signals worked out, medium and strong? I'd like to see those numbers. So problem is that my development team can only work on so much at a time. As I get more money, though, my research team will expand and I can get more quant guys in there to figure those things out. I'm not a quant guy, so that being the case, I apologize. So it looks like that answers your question there. All right, now, that being the case, it seems like everybody's got the basis for how this cloud works. And so now that we know the method of how the cloud works, I want to talk about current environments where we are right now, and then I want to talk about my hit list. My hit list is the things that are on my radar. And so, kind of like professional hitman, I try and be very efficient with my trading. I try for the sniper method, one shot, one kill. I try and be highly accurate. And that being said, I have things that are on my hit list, and these are the trades I'm looking to take out. And these are the ones I consider high probability targets. And so we'll talk about this towards the end of the show. But what I do want to do is talk about current environment of some of the pairs that I think are interesting. And then if you have certain pairs that you want analysis on, that you would like, that you're maybe in a trade or thinking about getting a trade, and you would like to know what the current Ichimoku models are saying about that particular trade and where the next likely direction is, feel free to chime in, and I'll be happy to field those. And let's talk about it so we can all get information and experience as to how this method works. Okay, so now first of all, we have this massive little downtrend here that's been happening for quite a long time, since late July till mid-August. Now, what is interesting here is that during this entire time period, while this trend looks like it was strong, it was below the Tenkan line. We only had a few little glitches here. This was the only close above it, and then everything else was below it for a good portion of this move, for about 90% of this move. But then we get this nice little reversal pattern right here, which is kind of interesting. We have the deep sell-off, the nice red candle, closing at the lows, just below 140. We attack below 140, and then we get a nice little bounce here, and we close at the highs. The next day, we get not only a strong push, but we completely eclipse the 2 days ago price action. Now, Yakoba is asking about the 20 EMA. You know what? Thanks for reminding me about that. 20 EMA is one of the moving averages that I will keep pretty much on every single chart. And it normally isn't red. It's normally blue. And I normally keep it thick. I'm still setting up these charts because I'm still setting up this laptop. So thanks for reminding me about that. Okay. So this thing produced a nice little bounce, but it didn't close above the tanking line. So I wouldn't be looking for any sort of reversal or call of the trend over. Now, once we started having several closes above the tanking line, to me that would be the impetus of, if I was short way up here, I would be paring back position with closes above the tanking line, especially since we had a month and a half below it. But then once we started to have closes above the Kijun line, to most Japanese traders, the Kijun line is one of the last lines of defense. The final line of defense, the final garrison, is the cloud itself. The cloud's far away. And so that being the case, my guess is if Japanese traders were short this, as soon as we had this close or this little wick, more than likely this close, boom, they were pulling back, if not most, all of their positions at that point. And look what's happened since then. The thing rallied off the 20 MA and it's climbed quite nicely since then. So that being the case, now that we've broken through the tanking line, we've got closed above it, the Kijun line, 20 MA as well, and we've now had several days above it, to me, a good portion of this move is over for now. Now, the final exit, there are a couple final exits. Some people are asking about limits. The final exit is you have a couple things. Usually you can use the Kijun line, price action behind the Kijun line, as your last line of defense. That would be method one. Method two would be an upward crossover in the opposite direction of the original move of the tanking line and the Kijun line. That would be the final one. If the bounce is sharp and it's impulsive, then the tanking line, Kijun line crossover will be a little bit behind the signal. If it's corrective and it's, much smaller candles and everything, then the chances are that the Kijun line, tanking line, Kijun line crossover will be a very effective method because it will be caught up to price action, because it will have taken its time bouncing, and the EMAs will have caught up to it. And then, in that case, the crossover will likely be a very effective exit. But if it's impulsive, then you can use the behind the Kijun line as your defense line. And that can really give you the information. That will probably give you the more advanced exit. Now, we got a question here. I'm in dollar-yen from yesterday based on the 1-hour Ichimoku. So far, it works fine. Took the first exit and moved to break even the second lot. Still in the trade. Thanks again. You are quite welcome. That is a good testimonial there. Good to have you on there. I've been actually having a lot of my individual clients that I trade personally contacting me about the Ichimoku, saying they've been taking signals and them working out very profitably. We will actually get to the dollar-yen and do some analysis on it. But based on current analysis, since we've had this now, this is an impulsive bounce. Price action alone would have suggested, hey, this is kind of for real. The next line of defense, or the next major line of defense, will probably be around the 150 area. But what is important here is that we've had, even though we haven't had a crossover, we've had a ton of price action clear through the lines of defense. So that being the case, as long as the intraday price action supports it, in the short term, we're bullish. This is bullish. In the medium to longer term, we're still in a bearish mode. However, the impetus for being short is declining significantly day by day here. And so that being the case, taking medium and strong signals to the sell side or the downside is fine right now. Either one will work fine. But from a medium and long-term perspective, we don't want to be adding new positions until we get a new fresh signal or we get some new closes below the Tenkan and the Kijun line. That would be the most ideal. We clear through these lines. That would create more impetus to go short again on a medium-term basis, and then a break below the lows would also add on to that. But until then, we're in a mixed bias right now on a medium-term basis. On the long term, we're still bearish. Medium-term mixed, short-term bullish because we've cleared through all these moves here. Okay, now, since we've had a question about the dollar-yen, let's take a look at dollar-yen. And actually, before we do that, I just want to chime in on the euro-dollar and the 1-hour chart. Now, we did get, on the 19th, a very nice medium crossover here. Price action was already above the cloud when that happened, So we could have been getting long between 43.50 and 4400. Technically, we haven't had a crossover in the opposite direction. We've had a couple Kijun line breaches on the 1 hour chart, so maybe we would have gotten out of it. But this created a very nice move for us. Very good at getting us in this position here and keeping us in for a long portion of the move. So according to this, if you didn't get out now, your stops would probably want to be sub 47 if you were long for a good portion of this move. And if it were to cross over to the downside, then that would say, okay, we're out of this move. But the next likely crossover after the downward one would be a strong upward crossover, and that would be in line with this traditional move. Impulsive, corrective, new impulsive move to the upside. So that could be cueing us in on that. Also, we have a rising cloud. They also call this a Muda Kumo. That's Japanese for rising cloud. And so that cloud, because it's climbing, means that support is climbing for it. It's trying to reach its way up to it, saying, hey, the line of least resistance is to the upside, clearly, at least in the short term. Now, Swede has a question here, and so does Lee. Where do we place the stop loss on this one here? It's an excellent question. I'm glad you asked that. Give me a second. I'm going to take a quick sip of this very nice, clean bottle of agua. Unfortunately, I don't like the company that makes it, but they make good water. I hope you didn't have to hear too much of me swallowing there. So, okay, now where do we place the stop? Well, traditional tri-tap. Scary. Very scary. Yeah, if I want to grow like cockroach wings and like have radium inside my system, then I would drink tap water. But I don't. So anyways, taking a look at this here, let's say this was the crossover, and let's say we had our breach of 12 pips. Let's say we got in here. Traditional Ichimoku Cloud says, hey, you'd want your stop below the cloud. Why? Because the cloud represents all the layers of support and resistance. And so that being the case, you'd want to be below it. I like to be about 6 to 12 pips below it. Now, for some intraday traders, that stop being around 42.94, that's a hefty stop. It's about 90 pips. Most intraday traders or day traders don't want to have stops at 90 pips. So how do we work with that? Well, whatever your normal position size is, whether it's 9 standard lots or 4 standard lots or 1 standard lot or mini lots or whatever, cut it in half to 1/3. If you're trading 9 mini lots or 10 mini lots, cut it to 5 mini lots. If the stop becomes really huge, 150, 200 pips, then I would say cut it to 1/3. And a 200 pip stop really is more of like a 65 pip stop. That's more digestible. The reason why I can do that, or the reason why I do that, obviously, is to reduce risk. But the reason why I have no problem taking on these larger stops after reducing the risk and cutting the position size is because the system is highly accurate. It's very, very accurate. In fact, if you were to look at the last month or two of the euro dollar, and you were to look at it on just the 1 hour time frame, all the medium and strong signals and how many of them went into profit and how many of them made money, the accuracy was very, very high. It was incredibly high. On top of it, there are other things that I do to mitigate risk. First of all, if I'm on a 30-minute or 1 hour time frame, I have an initial target, and then I have a second target. So what I do is I generally enter in 2 positions at the same time. So let's say I normally trade 10 standard lots. Well, if I'm trading Ichimoku, I'd reduce it to 5 standard lots. And then what I do is I break that into 2. And so my initial profit target on a 30-minute or 1 hour time frame, on a 30-minute is 30 pips. On a 1 hour time frame is 45 pips. So those are my initial targets there. And so if I have an odd number of lots, then I would take the greater portion off when I hit my initial profit target, and then let the smaller portion ride for the final exit, either the crossover in the opposite direction or the putting my stop behind, trailing it behind the Kijun line. So that's how I break that up. I generally like to break it up in 2s. Once I hit my first profit target, I bring the stop to free at that point. And so that is what I do to reduce risk as quickly as possible. Sybil's saying, would I trail it with the 20 EMA? I would not trail with the 20 EMA. I'd like to use the Kijun line as the trail. It gives me a little bit more of a defense. Being a 26-period moving average, more often than not, it's going to be behind the 20-period moving average. And so because of that, I like to use the Kijun line because that is the methodology I'm using here. So hopefully that answers your question. Now, that answers also hopefully answers your question, sweet, about where to place the stop loss. Now, sometimes there's going to be times where you get a crossover way above the cloud, and the price action, let's say, is way up here, and it's way far away from the cloud. Well, the cloud is way down here. Placing a stop 250 pips away is not necessarily palatable. So what you can do is you can take the thickness of the cloud and go 80% into it, and that would be your actual stop. So it'd be 80% of the distance in the cloud. So if it's a buy order, it would be 80% down. If it's a sell order, it would be 80% up into the cloud. So that would be my method for using a stop loss on that one there. So hopefully that answers your question. Now, Lee's asking a question. Does Ichimoku work equally well in trending and non-trending markets? And I got that key there. Thanks, Mod. So Ichimoku is designed to be a trend trading type indicator. And so because of that, it's going to perform far better in trending environments. Now, it's also going to perform better in trending environments based on the time frame. You could be in a range-bound environment on a daily chart. And, let's say the range is 500 pips wide. But on an intraday time frame, you could have trending moves. And so, yes, you may be in a range in a daily chart. You can switch to the intraday chart and say, hey, if I have trending moves, I'd be happy to take them. It doesn't work well on range-bound environments. It's not its forte. It's designed to catch very powerful moves where the order flow is heavily skewed to one side. Because when you have that, the likelihood of the momentum in that move continuing are very strong. And so that being the case, that's the type of moves it likes to get. All right, so we have a few minutes left here. I want to ask for Din's question, and then I want to go into my hit list for this week. Din's has a good question here. What does it mean when Chiku Spin A and B switch sides in the future? Well, there's been a lot of questions about this. There's been a lot of speculation and talk about this. Some people say it means nothing. Some people say it actually means something. My comments on it is this. If we remember what the values they're measuring, the Chiku Spin A is measuring the Tenkin line and the Kijun line. It's adding them together and dividing it by 2, and then it's sending it 26 periods ahead in the future. Now, if that's the case, well then a crossover of those should be indicating some sort of likely change in direction in the potential pair. Now, it doesn't work too well on some time frames, and it does work well on other time frames. Like when we had the crossover here, kind of indicated towards the top of the move. So it does have some information. For the most part, though, it doesn't have too much information. Most Ichimoku traders don't pay attention to it too much. It's not uber significant. It's not a major reliable signal. And so, yeah, it does have some information since the Chiku Spin A and B are composed of different pieces of data. The other one's the highest high and the lowest low, divided by 2 cent 52 time periods ahead. So that's saying, hey, we do have a change in hands here in terms of value. And it just means that the value of one is accelerating more than the other. So if you can think about them in their original values, then it is giving you some information. But overall, I don't use it too much as a signal, and most Ichimoku traders that I know of who are considered to be the experts do not as well. Okay, so that being the case, let's get into my hit list. And we're already on that. The euro-dollar on the 1 hour and I believe the 30-minute, you want to keep an eye on these. Particularly the euro-dollar here, because we're very close to giving an upper crossover. Also, the cloud is really thick, so that means the line of least resistance is to the upside. So the next potential upper crossover would be to the upside, a medium or strong signal, and that's kind of in line with the move there. So keep an eye on the euro-dollar on the 30-minute and the 1 hour time frame. Now, also, dollar-yen is looking hot on the 30-minute time frame because we've had an upper crossover here, and we're about to have a downward crossover here. And so technically we got a little choppy here. We did kind of have a bloop, bloop, up and down cross. And that's one of the things about the 30-minute is that the price action can get a little choppy. So I tend to take more of my signals on the 1 hour than I do the 30-minute but the 30-minute does have some great signals. Case in point, look at this strong signal right here. Boom. Caught a nice little move there on the dollar yen. So the dollar yen is close to producing one on the 30-minute time frame. Keep an eye on that one there, and that's to the downside. Next one, pound dollar, 30-minute as well. So actually, the pound dollar has already produced one here, and it would have hit its initial profit target, and then because the lines lapped on top of each other, it would have gotten you out. So you would have made your initial 30 pips because this is a 30-minute time frame. So this one would have already produced a signal, but if we can cross over downward just a little bit of the two lines here, we could get another upward crossover, which would be a strong one, and that being the case means that it would produce a nice strong signal to the upside, and with the thick cloud, everything's suggesting that that is the next likely move for this pair, and the same is for the last of the four majors, the dollar Swiss. Dollar Swiss is very close to producing a down signal here, and that would be medium to strong, and you would probably get your first 45 pips pretty quickly, and then from there, if it broke the 107 or the lows, then that could really continue on in a nice direction here. Now we got to move to the 1 hour for a couple of our commodity pairs. I got a few more. I got 4 more on my hit list. I'm just going to breeze through them, and then we'll be done. Aussie Dollar is on the verge of producing an upward crossover. We had a little bit of a sell-off here, but if it does produce an upward crossover, it's to the upside, strong signal. Remember, take your profit at 45 pips, bring the stop to free, and then boom. If we get a break of this price action here, it could be on its way. Same thing with the Kiwi dollar, bullish signal to the upside pending. They are seeing a little bit of a sell-off here, but pending bullish signal strong to the upside. And then the last two, some pairs you'll probably also really like. Euro yen, we need to get some yen pairs in here. So we have potential on the 1 hour for the euro yen, nice strong upward crossover, and also pound yen. So they're all, the market seems to kind of have a general alignment right now. It's pretty clear that where the bias is, it's anti-dollar right now, and it's anti-yen. And so that being the case, and also the price action is confirming as well. Strong impulsive moves followed by corrective moves here. And thick clouds. So Ichimoku Cloud is pretty much saying, hey, here's where the current market is aligned. And so that is pretty much it for my hit list right now. So I want to wrap things up here. And so Pauly G has the question, how about cross-checking the strength of the signal with momentum? Let's save that for next time because we're recording the session, and I have to make way for the next class here. So I want to thank you all for coming. It was awesome having everybody here. Hopefully you got some good information about the Ichimoku Cloud. So I want to thank everybody across the board here. Ruth FX. I have Jacobo, Jesse, Edem, Hanindo, Lee, Shep, Sweet, Tatuya, Pauly, Millward, Din, Bond, James, Rod, Denby, Ladovich, Sybil, Goss, Ula, good to see you as well. Ula, Rob, Joe from C, Lance again, Pauly G, Pip Rider, Alliance, Simon, Scott, Cat, JM, Zul, Dave, Andrew, Roberto, Boyke, good to see you as well, Boyke, Guardo, Jimmy FX, FXTD, and KDD. Awesome having you all here. Thank you all for coming. For those of you who have questions about my services, you can check out my website, twoindyskies.com. Also, email me directly, info@twoindyskies.com. I have a proprietary system, which actually has several systems built within it. That's available for sale, probably only for the next month or so, as I'm in negotiations right now to have somebody buy it out. I'm also having a broker finishing the beta testing on 2 of my proprietary systems that you can have automatically traded via them. And so if you're interested, check out my website and email me directly. Until then, thank you all for coming. I want to thank FX Street for hosting this show. And so until the next time, good hunting, everyone, and may the Forex be with